Samir Arora joining in on the show right now, founder Helios Capital, to discuss his outlook on the markets and where D Street is headed. And Samir, we've been hitting record highs day after day. Where is it that you're finding value in this market?
Well, broadly, our main job is to, within the market, sort the market among things that we can go long and things we can go short. So on a relative basis, there's always value. For example, I suddenly realized that I am short 16, what we broadly call consumer names, although they may not be literally consumer staple type names, but 16 names in the consumer sector. So what I mean by that is there are so many places which have excessive valuation and some which have reasonable valuation. It's not that you're finding something super cheap, but the whole idea in trying to beat the index is to basically sort the index. And that way there's many things happening.
I'm, as always, going through your Twitter page because there's always very interesting tweets that you come out with. You found something, you had things to say with respect to Paytm. I just want to know your view. How have you read into how things have unfolded there?
So we owned Paytm before. We bought it, and I think we told you, at least in my offshore fund, I bought it at some 520 rupees a year and a half ago, maybe a year and a half ago. And broadly, we kept it, and now we are sticking with it. Simple logic being that this news and all the actions are worth X%, according to us, say 30% of business for now in the short term. So the price before the news was around 700. So at 500, we'll see what to do.
Okay. Let's see where it really ends, but the saga for now continues and continues to be fairly volatile. Paytm. Samir, hi, this is Anisha joining the conversation. What about private banking names? Because I remember HDFC Bank was something that you still held a positive view on. Post the management commentary that we heard, is it more positive incrementally or it's just status quo? And even let's add Kotak to the list and ICICI Bank.
So we own HDFC, State Bank, and ICICI as our top three holdings. And in order, because of performance of State Bank this month, it has become number one. But so broadly, I still say HDFC Bank is number one. So it's like just behind the top holding. But big picture is that yesterday's that 1 hour thing I saw with the Goldman analyst. But broadly, the takeaway from there was that the management or that the company will focus on bottom line. And if the first, if you get deposits and you can use it to pay off loans, that is as good an alternative as trying to give out new loans. I mean, pay off the bonds that HDFC had got. Bottom line being that the strategy is good. I don't think, relatively speaking, they have lost any value. There are two different businesses. I think what they should have done is presented the two separately to show that the bank per se is doing as well as the bank was always doing, and that the HDFC Bank part is doing, say, as well or a little better as what it was always doing. And it is more that when you add the two, the numbers look notionally lower because of the lower margins in HDFC and the fact that you have to use some of the deposits. So it could have been explained more simply than it was explained. But for people who know it, I don't think anybody in any way took it negatively. And that is why you saw nearly every analyst reinforcing the buy that they had before. Of course, everybody was playing with their existing biases or views before the meeting. But it's more of the same. So it'll take time, but we are not selling anything. We will see now how it on its own has to go back to being number one. Right now, it has become number two because of State Bank of India's outperformance this month.
Absolutely, that outperformance, surely Samir, is coming in from the PSU pack as well. This is Winnie joining in the conversation. Good morning. I want to talk about the PSU pack, right? You do have a lot of these PSU names as well in the list coming in. We've already seen a very good run up in the last 1 month when you look at something like an HPCL as well. What's the view now on PSUs? Do you still think they're quite attractive?
So we have quite a few now. We have State Bank, we have Canara Bank, we have HPCL, we have BPCL, we have Bharat Electronics, and maybe we have one or two more. Broadly together, there must be 20% of the portfolio, which is good enough. So here the thing is that on BP and even HP and even BP, the bet is that they are very cheap. So from the point that because the valuations are so low, it also means because of this 30% dividend that all these guys have to pay out, the dividend yield also becomes very high. In the olden days, the P used to look low, but you would never get any real meaningful dividend. And so there was no, sort of benefit of just holding and saying, let's wait for what happens next. Right now, our assumption is that since BPCL there was an attempt to privatize it prior to election. I mean, prime means in this current term, in whenever 2021 was it, or I think, yeah, 21, pre the Ukraine war. And it didn't happen for various reasons. There will be definitely an attempt. Because at that time, the attempt was serious, but because of the world's view on what will happen to oil, what is the terminal value, do you want all these ESG related concern businesses, all those things went away post Ukraine when everybody realized that you still need coal, you still need oil, and everybody for himself, that there'll be an attempt and that should give another boost to this sector. And also the government, by not cutting prices ahead of elections, which normally was expected, has demonstrated that they're really keeping an arm's length, and maybe to build a case for the prospective buyer, whoever that is, whenever it happens, that see, even in the face of elections, we didn't interfere. So that is the thing for keeping it, other than the fact that it's very cheap and pays a decent dividend, and everything else, not everything else, but many things look expensive. So it is good to hold this. And we already maybe more than doubled in HPCL return.
I understand that, Samir. It's good to hold and you've already doubled, but do you think it is a sane level to add positions into PSUs?
So what happens for us is that we run a fund. So we are talking about the first buying for the fund at that time. But if today people put money in our fund, more or less we will buy plus minus the same stocks. Maybe once in a while we'll buy new stocks. So in that sense, this idea that it was a good price 2 years ago, but now it is not, this doesn't work when you are running a fund or PMS schemes or mutual funds or even our offshore fund, because new investors come all the time and you have to buy. Otherwise, otherwise you're basically you're effectively buying new stocks. But most of the time, if we are not selling it, we are willing to buy it, because we don't consider that a stock is in such a position, any stock, that I will not sell it for my old customers, but I will not buy it for my new customer. I don't like that kind of logic. Either it is good enough to be bought for the new guys and then it can be held for the old guys, or it goes. So that is why we can say, yes, we will add if you give us money. And please do give us money, and please sign on for SIPs if you have not done it, all of you.
No, we have, if we can say that, Samir, but because we trust your judgment there. So, interesting take as far as the PSUs are concerned. If you can hold it for your old, investors, why not just keep adding for the fresh ones as well? But shifting focus to what's happening in the pharma space as well, do you think there is a bit of a FOMO or missed out feeling on pharma?
Little bit could be, but fortunately we have two pharma stocks. But yes, we could have had more of those. Actually, our pharma analyst does say buy more. But we always feel that, oh my God, what do we sell to buy? And therefore we miss some of these things. Because at the end of the day, if you have $100 in my hedge fund, I can buy a little bit more than 100 also by going beyond 100%. But in most of our products, you have to sell something to buy, and that makes it a little bit more complicated. But yes, even we feel a little bit more we could have had.
Samir, you talk about mega trends, digitization, China plus one, geopolitics, etc. If you could just weigh that in with how one should be playing the markets, looking at some of these big trends evolving through the year, which are the sectors and the stocks in specific that could likely benefit from these mega trends?
So the mega trend is only, according to me, one, which is that India was always doing well, but because of having reached a certain size, both in GDP terms and in market cap terms, it is now too big to ignore. Previously, also many guys, maybe in US and otherwise, may have known that the Indian market, which by the way has done very well over last any period, 5, 10, 15, 20, 25 years, but they could afford to be lazy about it because it was maybe a small part of the world, small part of the index and things like that. And so the people who basically do jobs in these companies, rather than take it as their own money and are basically just doing a 9 to 5 job, could have ignored it. Now it has become too big, too visible. And also because most of these investors or many of these investors just following trend landed up in China and put big amounts and have been burnt beyond their wildest imagination, also want to come to India in some sense. I think that is the trend. That trend doesn't mean it has to go one way all along, because the Chinese market has become very cheap. So someday somebody might again play a catch-up trade. Their numbers of travel and plane trips and railway trips in this Chinese New Year have been very, very good. But even after that, their market did not go up. But broadly speaking, people won't completely walk away, but allocating new money that can come to India, and I think it will come. Although the start of the year has not been good for us in terms of FII flows. If you see in Jan and even Feb months to date, I think both the months have been negative. But still, this big macro trend is the trend for which we are all playing.
Absolutely. Samir, I'm going to pick out on a point that you were talking about first is in terms of the consumer side that you don't find quite exciting, right? What is it that you don't find exciting in the consumer space? Which part are you avoiding? And, what is it that you would maybe consider looking at in the
So
consumption
the
side?
thing is that if you say, many people talk about India being expensive as a market, I don't think India is expensive as a market, but Indian consumer sector is expensive as a sector. If you see the financials, they haven't really done much for 2 years. If you see the IT, which we don't own, but they haven't done much for 2 years. What has done well is these consumer guys, and obviously these newer things and other sectors like defense and others. But if you look at the big three big themes, the consumer sector all our life used to grow at maybe 15-20% with valuations in maybe late 20s, mid 30s. Then came this era of the last 5 years where people were brainwashed into saying that valuations don't matter, that these are 100-year stories. Now you see most of these guys, they grow at 10-12% or lower, and their valuations are in 50s. That we don't accept. We are willing to buy at 40-50p if you're growing 25-30% per annum for the next few years at least. That is the only thing we in consumer will buy, even if the valuations otherwise are looking high. And that's why we have these Zomato and Varun Beverages and all. In Varun Beverage, by the way, in my offshore fund, I've been 10 times already, but it grows more than 20-25%. That is what I need for having high valuations. So I don't like 50p for 10-12% growth, which is most of the old regular consumer companies that are considered as high quality and great outperformers in the past, but obviously have not done well for 3 years and most probably will not do well for the next few years till they either start growing at higher rates or their valuations puncture.
Okay. What is the next big risk then, Samir? Is that largely going to emanate from the global markets versus any, risks back home?
Nobody knows. That is the whole story of this risk business, that nobody knows. Who would have thought one day before Ukraine war, if you had asked me, will Russia attack Ukraine? I would have said no. By the way, I was reading a book. So the US warned Ukraine that Russians are about to attack you. And they said no. So the point is, don't get into that. Nobody knows. All you have to know is being able to react to it well. Maybe, so what we say is, beyond a point, we can't preempt these things, but we will react fast if such needed, whether right or wrong. So after the Ukraine war, we reduced or raised cash by about 15-20%. It didn't help because the market didn't fall. But the point is, that is a better way of doing it than to worry about a risk. That suppose we worry about a risk that China is being very aggressive against Taiwan. If it was, these days it is not, let's say, but generally. Now, what to do today? So point is, let's not go there. Broadly, we are okay. Our valuations, if you take out consumer sector, are broadly okay. They haven't gone up in the last two. By the way, in the last 2 years, our market, as in NSE 500, is cumulatively up maybe some 28-27%. So 2 years, 28% is not something which could have raised our valuation suddenly from what they were 2 years ago. It is in few pockets. So that you reduce, short, do whatever, and otherwise play for the bigger themes and hope and bet on India. That's it.
Hope and bet on India, and that's clearly worked very well till now. But before I let you go, Samir, what's your view on metals as a space? I know it's not a easily investable area because of the moving parts that is there, but any bet that you would want to take
No, we
there?
don't do it. We basically, in 28 years, I've never invested. So that way. And once in a while, we invest if it is doing really well and we feel paranoid, we might buy one stock and buy 2%. And that normally is enough to stop that rally, which is one reason I buy it. That let me stop it since I've never been able to make money and broadly very few have been able to in that. But we don't like it generally and we don't like it now.